Are you thinking about exercising some of your employee stock options, holding on to them for a year, and then selling so that you can benefit from the lower capital gains tax rates? Fantastic. You will probably save a decent amount of taxes if that works out. But what are the costs and risks? I'm Ken from Hoyt Wealth Management, and I'm going to break down AMT, the AMT credit, and why you may consider abandoning this strategy altogether. AMT, or Alternative Minimum Tax, is a parallel tax system that is calculated on every single taxpayer. However, under current law, AMT generally only affects employees who have incentive stock options that they've exercised and decided to hold beyond the calendar year. Back to your stock options. If you do exercise them and hold them a year and then sell, you will be taxed at much lower rates. Most likely it'll be 15% for capital gains, plus potentially another 3.8% for something called net investment income tax. This is generally a lot lower than ordinary income taxes. When you do sell, if you had paid AMT, you will most likely get some of that AMT credited back. The risk is that if the stock goes down after exercising and paying AMT, you've not only lost money on your investment, but you're also out the AMT, which will take a long time to recover in that scenario. One way to avoid AMT is to figure out exactly how many shares you can sell in a given calendar year without triggering AMT. There are some online tools to help you with this. My favorite is from Equity Simplified. You can find it by Googling Equity Simplified AMT calculator. Here's a few examples of AMT for a married couple filing jointly with $300,000 of combined income, with 5,000 vested incentive stock options with a grant price and exercise price of $10 a share. If they exercise and hold all 5,000 shares, they would have a built-in gain of $150,000, which would trigger AMT of about $32,000. However, if they only exercise 1,000 shares, there's still a built-in gain, but not enough to trigger AMT. So AMT would be zero. The risk of not exercising all of them is that if the fair market value goes up even further and then you exercise, the spread is going to be higher and therefore the AMT is going to be higher. So let's look at that same example, only this time the fair market value is not 40 but 60. If they exercise all 5,000 shares when fair market value is 60, the built-in gain or spread is now $250,000, which would trigger an AMT tax bill of $60,000 the following year when they file, even though they haven't sold the shares. Even if they only exercise 1,000 shares in that scenario, they would still be looking at an AMT tax bill of about $4,800 next year. Here's the bottom line. If you are mildly bullish on your company's prospects or are unsure, I recommend only exercising the shares that will not trigger AMT, so 1,000 shares in the first example. Some people repeat this process every year. They exercise the bare minimum, they sell them the following January, and then they exercise more, and just keep repeating that. On the other hand, if you are very bullish on your company's prospects and losing money on the investment and the AMT would not cause financial hardship, it would make a lot of sense to exercise as many shares as you can afford as early as possible before the fair market value goes up. Just be prepared to owe some AMT the following year. If your company is already publicly traded, I really like the idea of exercising and selling right away. I know this is a bit of a hot take because the entire gain would be treated as ordinary income and thus taxed at a higher rate. That's the downside. The upside is that you are not going to be overexposed to your company's stock. You won't be worried about the stock for the next year while you're holding it. and you won't owe any AMT. You're basically ripping the Band-Aid off, paying the taxes, and taking that money off the table. I hope you enjoyed this video. Like or subscribe if you want to hear more. Thank you.